How does a put calendar spread perform during Black Swan events? Have you ever wondered how a put calendar spread behaves during those unexpected market crashes known as Black Swan events? Let's break it down in simple terms. A put calendar spread involves selling a near-term put option while buying a longer-term put option at the same strike price. This strategy is often used when traders expect the stock price to stay steady or move slightly up in the short term, with a potential drop later or an increase in market volatility. Now, during Black Swan events, which are rare and extreme market movements, the performance of this strategy can be quite tricky. One major factor is volatility. Typically, Black Swan events lead to a sharp increase in implied volatility. The longer-term put option in the calendar spread usually gains value when volatility rises. This can boost the overall value of the spread, possibly leading to profits even if the stock price drops sharply. Next, let's consider stock price movement. The short-term put option sold in the calendar spread may quickly become either deep into money or out of the money, depending on how the stock moves. If the stock price plunges below the strike price before the short put expires, it could incur losses. However, once the short put expires, the trader still holds the long put, which can benefit from further declines in the stock price. Time decay is another important aspect. The calendar spread profits from the faster time decay of the short-term put compared to the long-term put. In a Black Swan event, if the stock price drops and stays low, the long put gains value, which can offset losses from the short put. However, if the stock price recovers quickly, the short put may lose value rapidly. Risk is a key consideration too. While the maximum loss is limited to the initial cost of entering the spread, a sudden market crash can lead to significant short-term losses on the short put leg. This situation can make managing the position challenging. Traders may need to adjust their strategy, such as rolling the short put to a later expiration or a different strike price to reduce risk. For traders using put calendar spreads during uncertain times, increased volatility can be beneficial. However, they must be cautious about sharp price movements. This strategy is generally not meant for large immediate price drops but is better suited for situations where volatility rises and the stock price remains near the strike price. In summary, during Black Swan events, a put calendar spread can gain value from the increase in volatility and the long put options premium. Yet, the unpredictable price moves can lead to losses on the short put leg, making the overall position volatile and requiring active management. This strategy works best in scenarios with a neutral to mildly bearish outlook and rising volatility, rather than sudden, extreme market crashes.